The stock market just hit a new record high above 7,700. Yet the latest labor report showed a sudden loss of 23,000 jobs. Wall Street is sending two completely opposite signals at the exact same time. Corporate profits for the second quarter are up an astonishing 51%. But consumer spending metrics across major global economies are rapidly cooling off. Most retail investors are walking straight into a trap this week. They are buying the rally right before major corporate earnings drop. Big money managers are not chasing this high. They are rotating into very specific global stocks ahead of massive volatility. This week brings a pivotal wave of earnings across the US, Europe, and UK. You need to know exactly how to position your portfolio right now. We will break down the exact stock predictions for the coming days. You will learn expected earning numbers, market reactions, and key price levels. Let us start with the American technology backbone reporting midweek. Cisco Systems reports earnings on Wednesday after the market closes. Applied Materials follows right after on Thursday afternoon. Wall Street is expecting Cisco to deliver solid enterprise networking revenue. Analysts expect earnings per share near 87 cents on $13 billion in revenue. But what most people do not know is where the real revenue is hiding. Cisco has quietly shifted billions toward enterprise security and hardware infrastructure. If Cisco beats earnings but lowers full-year guidance, the stock will drop. A guidance cut will likely pull tech indices down 2 to 3%. Applied Materials gives us a direct view into global microchip production. Analysts expect Applied Materials to post revenue near $6.5 billion. Chip manufacturing equipment demand remains hot due to artificial intelligence infrastructure buildouts. A beat here could trigger a fast 4% rally in semiconductor stocks. But if capital expenditure numbers slow down, chip equipment stocks will sell off hard. To trade this safely, watch the immediate options implied volatility before earnings release. Do not place directional bets right before the earnings call. Wait for the initial reaction during post-market trading hours. Look for a key support test on Cisco near $50. Look for Applied Materials to test key support near $200. Buying the pullback after initial earnings panic often yields superior risk-reward. Now let us look across the Atlantic at European semiconductor supply chains. European tech giants play a crucial role in feeding global artificial intelligence expansion. What happens in Europe directly impacts tech stock performance in New York. Eurozone economic data shows manufacturing activity expanding at 55.6%. German factory orders recently beat consensus estimates by a healthy margin. The euro is holding steady near 1.15 against the US dollar. This currency stability protects European exporter margins in the near term. European tech equipment suppliers are benefiting from steady international order books. Companies like ASML provide the lithography tools that power American chip designers. The surprising part comes next when you look at European industrial margins. Input costs for European manufacturers have dropped significantly over recent months. Lower energy prices are directly boosting operating margins across European industrial firms. Analysts expect European tech supply chain earnings to beat conservative consensus estimates. A beat here will likely spark a rally in European stock indices. The German DAX index could retest recent all-time highs this week. How should you trade European exposure right now? Focus on high-quality European tech suppliers with low debt. Look for entries when broad European market ETFs pull back slightly. Set tight stop losses just below recent daily low levels. Keep your risk per trade strictly below 2% of account capital. What few traders are watching is the upcoming shift in global retail dynamics. Retail earnings give us the truest picture of real consumer health. Home Depot and Chinese retail giant JD.com report earnings very soon. Home Depot serves as a direct proxy for American housing and renovation spending. Analysts expect Home Depot revenue around $42 billion for the quarter. Home improvement spending has slowed down due to elevated mortgage interest rates. If Home Depot warns on consumer weakness, retail stocks will drop fast. Simultaneously, Chinese e-commerce giant JD.com reports earnings on Thursday morning. JD.com earnings will reveal the true strength of Asian consumer demand. Wall Street projects JD.com revenue around $43 billion US. Asian consumer discretionary stocks have been trading at deep valuation discounts. A surprise earnings beat from JD.com could spark a sharp relief rally. Chinese tech ETFs could surge 5 to 8% on positive guidance. Before you skip to the next stock, consider this crucial retail reality. Consumer companies are struggling to pass higher prices onto everyday shoppers. Profit margins are beginning to compress across middle-tier retail businesses. Investors should avoid retail stocks with high debt and falling profit margins. Instead, focus on low-cost retailers with strong cash balance sheets. Look to short, weak retail stocks that miss earnings and lower guidance. Look to buy market leaders that prove consumer pricing power remains intact. Before we analyze the explosive high-beta tech stocks, hit that subscribe button. We post daily actionable stock market breakdowns to keep you profitable every week. Joining now ensures you never miss critical trade setups before the market opens. Now let us examine the high volatility growth stocks reporting this week. High beta growth stocks will see the biggest price swings of the week. Space infrastructure leader Rocket Lab reports second quarter financial results. Supermicro and CoreWeave also step into the earnings spotlight. Rocket Lab has seen rapid growth in launch contract bookings recently. Wall Street expects Rocket Lab revenue near $100 million. Investors want to see expanding launch frequency and satellite manufacturing revenue. Rocket Lab stock frequently moves 10 to 15% after earnings releases. Supermicro remains a high-speed barometer for server rack demand. The options market is pricing in a massive 12% expected price move. Supermicro needs to show strong profit margins alongside revenue growth. If gross margins compress, short sellers will aggressively push the stock lower. CoreWeave will also reveal critical trends in cloud compute capacity leasing. How should intermediate traders handle these high volatility earnings plays? Never gamble full position sizes on high beta growth earnings releases. Consider using defined risk options strategies like defined risk vertical spreads. A bull put spread allows you to profit if support holds firm. An iron condor allows you to profit if volatility crush occurs post-earnings. If you trade shares directly, wait for the first 15 minutes after open. Let the market digest the earnings report before entering any position. Set a hard stop loss at 5% below your entry point. Inflation data drops this week to completely reshape market expectations. U.S. Consumer Price Index and Producer Price Index reports land midweek. Consensus estimates expect headline inflation to rise by just 0.1%. Core inflation is projected to rise by 0.2%. Slower inflation gives central banks permission to pause or cut interest rates. Low inflation readings usually trigger an aggressive stock market rally. High inflation readings will spark fears of prolonged high interest rates. The S&P 500 is currently trading at 20 times forward earnings. That valuation leaves very little room for macroeconomic error or earnings misses. If CPI comes in hotter than expected, stocks will sell off sharply. Small-cap stocks in the Russell 2000 are especially vulnerable to interest rates. Here is your step-by-step preparation plan for this trading week. First, keep 20% of your trading portfolio in liquid cash. Cash gives you flexibility to buy high-quality pullbacks during earnings panic. Second, trim profits on stocks that have rallied over 30% recently. Third, hedge your long portfolio using short index futures or put options. Focus on risk management above everything else in high volatility weeks. Calculate your exact position size before entering any new trade today. Never risk more than 1 to 2% on a single idea. Focus on global companies with real earnings and strong pricing power. Look out for our next video posted daily to stay ahead of the market.